Hey everybody, welcome to Mortgage Today for Friday, June 7th, 2024, and oh, what a day it was. We had a rough open for UMBS, down 36 basis points in the first hour of trading. Stock futures were flat. The jobs report was much stronger than expected. Nonfarm payrolls came in at 272,000 on a 180 forecast. Big beat there. It was 175,000 previously. Non-farm payrolls came in at 272,000 jobs created on 180,000 forecast. It was 175,000 previously. The unemployment rate freakishly stayed pretty much unchanged. Came in at 4% on a 3.9 forecast. It was 3.9% previously. Wages came in up 0.4 on a 0.3 forecast. It was 0.2 previously. Year over year, that translates to 4.1% versus a 3.9 estimate. So wages keep going up just enough for people to keep piling money onto those credit cards and making those minimum monthly payments. So needless to say, 272,000 versus 180 is not in line with recent hopes of a cool down in the labor market. Bonds had been positioning for a soft report and are unsurprisingly a bit surprised in a bad way. The number of new jobs created came in, like we said, at 272,000, which is much higher than the 180,000 being estimated ahead of time. This component comes from the establishment survey, the survey of businesses, basically. However, the unemployment number came in higher as well at 4% versus a 3.9 expected and the 3.9 from last month. So how can we be more jobs created but unemployment goes up? Because the unemployment number comes from the household survey, a survey of people. But what is really suspect is that these two surveys are showing very different data that supports the growing idea out there that the data is being manipulated or downright fabricated. I would wonder if you are going to lie about one piece, why not lie about both? But definitely seems like there could be some iffy data collection methods, if nothing else here. For sale inventory increased 35% last week, according to Realtor.com. We are seeing an increase in affordable inventory as well. Inventory remains between 20 and 60% below pre-pandemic levels, depending on the region. We still have a ways to go in order for the housing market into balance. However, we are moving in the right directions. Bonds made it almost all week, putting on a superhuman display of immunity to bad news. But Friday's jobs report was the kryptonite. Whether or not a trader has any criticism for volatility in the payrolls data, they still agreed on the move with 10-year yields up nearly 15 basis points by the close. UMBS outperformed nicely, as we were hoping they would, thus limiting the worst possible rate sheet outcomes. In fact, we're ending the week in better shape than the last, and thoughts are already turning towards next week's bigger ticket events, CPI, and the Fed on Wednesday. And yes, this is the dots meeting for the Fed. So UMBS closed the day down 43 basis points at 100.27. The 10-year came in at 4.435. But at 100.27, that changes all of our graphs. We were up in this range previously, hoping that we'd be able to crack through that 100.872, but now right down there, pretty much sitting right on that 25-day moving average with two ceilings right above it and a couple of floors below it. But looking at next week, we do have an eventful week. A bunch of auctions at the top of the week. We have a 3-year note auction on Monday, 10-year on Tuesday. Wednesday is the big ticket items. We get CPI, core CPI, and then the Fed rate decision with dot plots and the Fed press conference. Thursday we get jobless claims and producer prices, and also Fed Williams speaking. And then on Friday we got a couple more Fed speakers and consumer sentiment. So busy week next week. If you have some time over the weekend, try to improve your own brain and check out some stuff from our sponsors and our core influences, especially our sponsor at thatmakesense.com.